50-year loan wipes out the one thing Americans could count on as homeowners: equity. The faster you pay down the principal, the faster you build wealth. But when the loan term doubles, equity growth becomes glacier. And that leads to something we are already seeing today. And that's people in their 60s, 65, that are selling their big 2-story homes and finally downsizing into older, smaller, easier to maintain single-story homes, but are now carrying brand new 30-year mortgages on that new purchase that won't retire when they do. So a 50-year mortgage takes this current trend and it cements it into the future. The typical first-time buyer in America is over 40 years old. That used to be the age they traded up into their dream home. Today, that's the age where they're getting the keys to their first-time entry-level home. Now, imagine pairing a 50-year loan with that timeline. You're paying it off at 90 or never at all. The generational handoff problem. Traditionally, one of the greatest gifts parents could give their children was a paid-off house. That was how generational wealth started. Mom and dad hand you a house that has no mortgage attached to it. But if nobody ever pays off their house anymore, what exactly are we handing down? A house with a 33-year balance remaining? That isn't generational wealth. That's a baton pass in a relay race that nobody asked to run. We're already seeing this in the car market. Look at car loans. 5, 6, 7-year financing for cars used to be unheard of. Now it's normal. People are always upside down. They owe more than the car is worth almost the entirety of the loan. Housing is now starting to be modeled in the same way. Longer terms, slower equity, higher risk. When you stretch debt long enough, the borrower becomes a subscriber, not an owner. So what would the market impact be? This is one part nobody in real estate wants to admit.